welcome back. Let's solve this question. So you're given this information for Lexus Limited, and you're told that you need to use the indirect method to calculate cash flow from operating activities, cash flow from financing activities, cash flow from investing activities, the net change in cash, basically the cash flow statement. And you're told to use the indirect method, so that's what we'll do. Okay, so we'll start by organizing our Excel sheet here. We'll need first column, that'll just be for the margin, and then I guess you really only need two columns. Let's keep it simple. Okay, so there you go. This is what it looks like. So the first one will be the name of the company. Always the name of the company first, Lexus Limited. Then the name of the statement. We're making a cash flow statement. And then the date for the year ended December 31st, 2005. Okay. And I mean, you can add that this is in dollars. Great. So a lot of this is done from memory, right? So you should know that your operating activities comes first. And the first line of operating activities, if you are using a little typo to fix, is the net income. So we check our income statement. You've got your net income here, 573,692. So net income, 573,692. Okay. Then you want to adjust for non-cash items. So the first one would be your depreciation expense. We always add back depreciation expense because it's a non-cash expense. So 232,400, 232,400. And then any gains or losses. But remember, gains and losses need to be reversed. So since we had a gain on sale of equipment right here on the income statement, I'm going to add this in here, gain on sale of equipment. But you're going to have to make that negative. So you always reverse gains and losses. So a gain which is inherently positive needs to be negative here, and a loss, had we had one, which would inherently be negative, it would be positive. And again, the reason for that is that it's not an operating activity that caused this gain. So we're removing this gain from the net income. Our goal here is that we're trying to reconcile your net income to specifically cash from operating activities. So I'm removing anything that was not an operating activity, like this sale of equipment. I didn't have any losses, so that's good. Now we want to adjust our working capital. So the way we do that, starting at our current assets, I look at accounts receivable. 2004 to 2005, it increased. You see that? It went from 443 to 635. So I'm going to write here, increase in accounts receivables. And the difference is, I'm just going to do it here, 635, 400 minus 443, 400, 192. But remember that when assets increase, your cash decreases. So this number is actually negative. It's negative for cash. So an increase in accounts receivables means you actually collected less cash. So instead of writing 192, I'm going to write negative 192. Okay, and then we'll continue. So we had what here? Inventory. Inventory increase as well. So it's going to be the same thing. Increase in inventory. I want to make it negative. So if I do 634 minus the previous year, 277. So 357. Again, it's an increase, but I made it negative because that's what we just talked about. Prepaid rent, same thing. It increased by, you could tell there, $6,000. So increase in prepaid rent, I'm going to put negative 6,000. An increase to an asset is a decrease to your cash. Then we skip property, plant, and equipment because that's a non-current. We only look at current assets and current liabilities. Go to accounts payable. For this, you want to remember that liabilities and cash go in the same direction, right? So here, if there's an increase in accounts payable, it's actually an increase to your cash. So 367 minus 324. Your accounts payable increased by 43,000, and therefore your cash from operations also increases by 43,000. Income tax payable, same thing. Increase in income tax payable. It increased by 5,000. You can tell the difference there. And then the bank debt, that's a financing activity. Anything with equity is financing. So this is done now. We're going to put a line here. And we'll put cash from operating activities. And we're just going to do a sum from your net income all the way down. You want to add everything up. Okay. So your cash from operating activities is 154,000. Then we move to investing activities. This is everything to do with your buying and selling of long-term assets. And so if we look at, you always want to start looking at your additional notes at this point. A piece of equipment was sold in 2005. The equipment had an original cost of 105 and a book value of 58. So we sold equipment that had a book value of 58. This means that the equipment was worth 58,000 after depreciation. And if you look at the income statement, we had a gain of 145. What does that mean? It means we sold it for $145,000 more than its book value. So I know here that I had a sale. So I'm going to write proceeds from sale of equipment. The equipment was worth 58, and I sold it for an $145,000 gain. So that's how we know that we sold it for $203,000. And it says no other capital assets were sold during the year. The company purchased equipment as well. Now here's the tricky thing. They told you they bought equipment, but they didn't tell you how much they bought it for. And so we need to use our accounting skills to figure this out. I'm going to make a little T account here. I'm going to call this PPE. And I'm just going to use this to investigate my my statements. So look, we started the year 2000. Well, I guess we ended 2004. So we started 2005 with 3,480,100 in PPE. And we ended the year of 2005 with 3,575,100. Now these are not book values, right? These are historical costs. This is not including depreciation. See, I didn't bring in a accumulated depreciation. So I know that these are the original costs of these assets. We also know that we sold equipment that had originally cost us 105, which means there would have been 105 here on the credit side because we know that when we sell equipment, we credit equipment. Okay, well, is this balancing right now? It's 3,480,100 minus 105. Does that equal 3,000,005? No, that doesn't make any sense. And this is how you can find what you purchased. There's some missing value here. Oh, sorry, guys, these are all on the wrong side. So this would go, hold on a second. This would go here, this would go here, this would go here. Okay, my bad. Same spiel. It's really just I had put them on the wrong side. So I know that I had purchased some PPE, right? And we know that when we buy PPE, we put it on the debit side. So let's just find that number. You could write it out as an equation. 3,480,100 plus X minus 105 equals 3,575,100. And you just solve for it algebraically. Okay, so I'm going to do that right here. So I'll do, it's basically this plus this minus this. I know I purchased new equipment for 200K. So I can write here, purchase of equipment minus 200,000 because it's an outflow of cash. And there you go. Since that was our only long-term asset, we're done. Right? We're done with this section. So I'll put a line. I'll add these two together. It's 3,000, so positive. So I'll write cash from investing activities. Okay. We'll know later on if this is right. We're going to check if we balanced at the end, but let's assume for now that we're good to go. Financing activities. For this, I also like to look at the notes first. 25% of the dividends declared in the year were stock dividends. Okay, so we know we declared some dividends, but we also know that some of that was stock dividend, which means it wasn't paid in cash. Okay, cool. So now let's go back here. We'll start with long-term debt. Started at 1.9 million, ended at 1.9 million, nothing to do. We didn't take on any new debt. We didn't repay any debt. Done. Common shares. Started at 624, ended at 878, which means we issued new shares. And since they didn't tell us anything specific, like we issued shares to pay for a building, we can assume that all those shares were issued for cash. So I'm going to write here proceeds from issuance of shares. I'll just take that difference, 878,300 minus 624,000. I received $254,300 in cash for my shares. Retained earnings. Started at 703, ended at 617. So that's interesting, right? So although we had a profit of 500,000, over 500,000, our retained earnings fell. Why? That must mean that we issued a massive dividend. Remember, again, if I use T accounts here to investigate, I'm going to make a T account for my retained earnings. If you don't like T accounts, you can use a formula as well. But right, we started with 703. Now this correctly goes on the credit side because this is an equity account. And we ended with 617. Okay. We know that net income, 573, should go into retained earnings. So I'm going to write here 573, 692. This is not balancing though. We know that we declare dividends. It's the only thing that comes out of retained earnings. So let's find that number. 703, 500. And by the way, if you don't like T accounts, remember this formula. Beginning retained earnings plus net income minus dividends equals your ending retained earnings. Like you didn't need the T account at all. So I could have just said 703, 500 plus 573, 692. I'm ultimately going to do the same thing. Minus X gives 617. Solve for X. Okay, let's see what that is. It's basically this. Actually, it's this plus this minus this. 660. Good. So we know that we declared 660. We know we paid the whole thing because there was no dividends payable in your liability. So the whole thing was paid, but 25% of that was not paid with cash. On the cash flow statement, you only put your cash dividends. So I'm going to write negative because it's an outflow. This number times 25 times 75%, right? Because only 25% of it was a stock dividend, which means the other 75% was paid in cash. 495. Okay, we're done with shareholders' equity, which means we're done with this whole thing. Now it's the moment of truth. If we add these two, we get our total. So it's negative. I'm going to write cash used by financing activities. Now I want my net cash flow in 2005. This plus this plus this. Your three totals basically. So if I add all those up, my net cash flow in 2005 is negative 83,752, which means technically my cash should have decreased by this much. So I'm going to take my cash balance in 2004, the previous year, that was what? 275, okay? 275,000. And I'm going to add these two numbers together. This plus this, 191. Cash balance in 2005, 191,000. Let's see what we had. We had 26,200, which means somewhere to what it is. It's actually the shares. So because they said that there was a stock dividend, that means that this $254,300 change in shares was not actually all cash. So if I just do the math here, what was the stock dividend? The stock dividend was this number times 25%, 165. So $165,000 of those shares were actually not issued for cash. And so I have to take this number now, which was the difference, and remove from it 165,048. Boom. Now we balance. Okay, so just be careful there. I mean, very clearly easy to miss. But don't miss it, right? They said it here. I should have paid closer attention to the implications, not just to retained earnings, but to the shares as well. Okay, so once you fix that, you see that your ending cash is actually correct, and you're good to go. If you have any questions about this, if there's something you're confused about, there's many, many ways you can reach me. You can ask me a question directly on in the comments. You can follow Think Checkmark on Instagram. You can follow Prof.John K on Instagram. You can also check out checkmarktutorials.com. We have tons of crash courses, mock exams, practice questions, tutorials for business courses all over Canada. And thank you. See you next time.